You have been sold a lie. It is a very comforting, culturally accepted lie that almost every single person in the middle class is living right now. The script is handed to you the moment you are born. You go to school, you get good grades, you secure a stable job, you work hard for 40 hours a week for 40 years, and eventually, you retire wealthy and happy. But if that formula actually worked, why are over 60% of Americans currently living paycheck to paycheck? Why are people who earn six-figure salaries still drowning in consumer debt, living one medical emergency or one corporate layoff away from total financial ruin? Warren Buffett, widely considered the greatest investor in human history, figured out the massive, glaring flaw in this system decades ago. He realized something that the traditional education system is specifically designed to hide from you. Being a good, loyal employee is mathematically the absolute worst way to build wealth. To understand why the employee mindset is a trap, we have to look at how the modern job was actually created. The 40-hour work week and the standard corporate structure weren't designed to make you financially free. They were designed during the Industrial Revolution to create compliant, reliable factory workers. Industrialists like Henry Ford championed the 9-to-5 schedule not out of immense generosity, but because it optimized human labor while leaving workers just enough free time to buy the consumer goods the factories were producing. The entire system is built on a fundamental, undeniable flaw. You are trading your time for money. When you are an employee, your wealth-building equation is broken from day one. You have capped your earning potential to the physical limits of the clock. Think about the basic math. If you make $30 an hour, the absolute maximum you can earn in a 24-hour day is $720. But you are a human being. You have to sleep, you have to eat, you have to commute, and you have to take care of your family. Realistically, you max out at maybe 8 to 10 hours of productive work a day. Your income has a hard, heavy, unbreakable ceiling. This ceiling doesn't just apply to minimum wage workers. Even if you are a highly paid corporate lawyer, a specialized surgeon, or a top-tier consultant billing $300 an hour, you are still trapped by the exact same 24 hours in a day. If you stop working, the money stops flowing. As Warren Buffett famously said, if you don't find a way to make money while you sleep, you will work until you die. As an employee, your income is entirely dependent on your active, continuous physical or mental presence. If you get sick, the machine stops paying you. If you want to take a month off to travel the world, the machine stops paying you. You do not own the wealth-generating engine. You are merely a replaceable, highly taxed cog functioning inside of it. Wealthy people operate on a completely different paradigm. They do not trade time for money. They trade money for assets. And those assets work relentlessly to buy back their time. Warren Buffett didn't become a billionaire by working 100 billion hours. He achieved his massive fortune by acquiring equity, true ownership in businesses that operate 24 hours a day, 7 days a week. Regardless of whether he is sitting in his office in Omaha, reading financial reports, or sleeping soundly in his bed. However, the trap of time is only the first obstacle. The second barrier is how the tax system is weaponized against the employee. In the United States and in most developed nations, W-2 income, the money you make from your paycheck, is the highest taxed form of income in existence. Before you even see your money, the government has already reached into your pocket and taken 20, 30, or even 40% of your labor. You are paying taxes on the front end. Investors and business owners, on the other hand, are taxed entirely differently. They are taxed on capital gains, which carry significantly lower rates, and they have access to a labyrinth of legal deductions. An employee earns, pays taxes, and then tries to live on what is left. An owner earns, spends on expenses, and pays taxes only on what remains. It is a completely inverted system, designed to keep the working class exactly where they are, working. But let's say you manage to navigate this. Let's say you get that massive promotion. You beat the tax bracket, and you are finally making $100,000 or $150,000 a year. Society dictates that you have made it. You should be rich. But here is the tragic reality of what happens next. This is where the third invisible killer steps in. The psychology of lifestyle creep. You trade in your perfectly reliable paid-off Honda for a brand new financed BMW. You upgrade from a modest, affordable apartment to a luxury high-rise condo downtown. You stop cooking healthy meals at home and start spending thousands of dollars a year ordering premium delivery every night. You buy the newest iPhone, the designer clothes, and the expensive watches, entirely on credit. This phenomenon is deeply rooted in human psychology and is tied to Parkinson's law, which states that your expenses will always organically rise to match your income. There is a psychological concept called the Diderot Effect, named after a French philosopher who lived in poverty until he was suddenly gifted a large sum of money. He bought a beautiful, luxurious scarlet robe, but soon he realized that his old desk didn't match his new robe, so he bought a new desk. Then his chairs didn't match the desk, so he bought new chairs. Before long, he had entirely depleted his fortune just trying to maintain the aesthetic of his initial purchase. This is exactly what happens to the modern employee. The system, fueled by multi-billion-dollar marketing algorithms and the fake realities of social media, constantly pressures you to buy things you don't need, with money you don't actually have, to impress people you don't even like. Most high-earning employees do not actually manage wealth. They act as a temporary funnel, passing their hard-earned salary directly into the pockets of massive corporations. The bank takes the mortgage interest, the auto lender takes the car payment, the credit card company takes the 24% interest fee, and whatever tiny fraction is left is happily absorbed by Amazon and Apple. High income does not equal high net worth. You can make $500,000 a year, but if you spend $500,000 a year, you are still broke. You are just broke at a higher standard of living. And what about that incredibly small, tiny fraction of cash you do manage to hold onto and put into a savings account? It is actively being destroyed by a silent, invisible tax called inflation. The fiat money system is designed to lose value over time. As governments print more money to cover their massive debts, the dollars in your bank account lose their purchasing power. Warren Buffett views inflation as a giant, unavoidable corporate tapeworm that silently consumes your wealth from the inside out. If you leave your money sitting in a traditional savings account earning a microscopic fraction of a % in interest, while actual inflation sits at 3, 4, or even 8%, you are mathematically, undeniably losing wealth every single day. You are working harder and harder, sacrificing your youth and your energy, yet you are running on a financial treadmill that is constantly increasing in speed. $10,000 today will not buy you $10,000 worth of goods in 10 years. It might only buy you half as much. This is why saving your way to wealth is a myth. To break out of this vicious cycle, you must undergo a radical psychological shift. You must permanently abandon the mindset of a consumer and adopt the mindset of an owner. When a typical consumer looks at a brand new $60,000 car, they ask a very dangerous question. How much is the monthly payment? If they can afford the $800 a month, they buy the car, entirely ignoring the interest and the massive depreciation. When an investor, thinking like Warren Buffett, looks at that same car, they ask a fundamentally different question. How much future wealth am I permanently destroying by spending this capital today? They know that investing that $60,000 instead could result in hundreds of thousands of dollars of future freedom. They choose future freedom over present status. So, how do we actually fix this? How does a normal, everyday employee transition into a wealthy, independent owner without taking catastrophic risks? You do not need to invent the next revolutionary tech startup. You do not need to possess a genius-level IQ. And you absolutely do not need to gamble your hard-earned savings by day trading volatile penny stocks or chasing the latest cryptocurrency trends. In fact, Warren Buffett heavily advises the average person against trying to pick individual winning stocks. The answer is incredibly boring, intensely unsexy, and requires absolutely zero daily effort, but it has a near-perfect success rate over a long enough time horizon. The ultimate wealth-building secret of the ultra-rich is the mathematical miracle of compound interest, harnessed through broad market index funds. Warren Buffett's absolute favorite investment vehicle for the average person is the S&P 500 Index Fund. This is not a single risky company. It is simply a diverse basket representing the 500 largest, most profitable, and most dominant companies in the United States. It includes Apple, Microsoft, Amazon, Google, Johnson & Johnson, and hundreds more. When you buy a low-cost S&P 500 index fund, you instantly own a tiny, legally protected piece of the entire American economy. If one company goes bankrupt, it is automatically removed from the index and replaced by the next rising star. The index is a self-cleansing, wealth-generating machine. Buffett believes in this strategy so much that in 2007, he made a famous $1 million bet against the smartest hedge fund managers on Wall Street. He bet that a simple, unmanaged S&P 500 index fund would outperform their complex, highly paid, hyperactive trading strategies over a 10-year period. The hedge funds tried every trick in the book. They traded daily. They shorted the market. They used immense leverage. Buffett did absolutely nothing. He just let the index fund sit there. 10 years later, Buffett won the bet in a landslide. The highly paid financial experts could not beat the simple, boring, consistent growth of the overall market. Let's look at the actual math of compound interest, because this is where the numbers become truly staggering. And this is exactly what schools refuse to teach you. Imagine you are 25 years old. You commit to taking just $300 a month. That is $10 a day. It is the cost of a fast food meal or a couple of premium coffees. Instead of consuming it, you invest it consistently into an S&P 500 index fund. You set it to auto-invest so you don't even have to look at it. Historically, despite wars, recessions, pandemics, and political turmoil, the U.S. stock market has returned an average of about 10% per year over the long term. If you never increase that $300 a month, and you just let it sit, reinvesting the dividends, allowing it to compound relentlessly. By the time you reach the traditional retirement age of 65, you will have contributed a total of $144,000 of your own money out of your pocket. But your actual account balance, it will be over $1.8 million. Think deeply about that figure. Over $1.6 million of that final balance is pure, unadulterated growth. It is money that you did not work for. It is the literal definition of making money while you sleep. Your original dollars acted as seeds, growing into trees, which dropped more seeds, eventually creating a massive financial forest. That is compound interest. It is your money going to work, putting on a hard hat, hiring other dollars, and building an army of capital that works tirelessly for you 24 hours a day, without ever complaining, without ever needing a vacation, and without ever asking for a sick day. Now, compare this to someone who waits. Let's say you ignore this advice. You succumb to lifestyle creep in your 20s and 30s, and you finally wake up at age 45, realizing you need to prepare for retirement. To reach that exact same $1.8 million by age 65, you can no longer invest just $300 a month. Because you lost 20 years of compounding time, you now have to invest over $2,500 every single month to catch up. Time is the most critical ingredient in wealth creation. Warren Buffett's longtime business partner, the late Charlie Munger, famously said that getting your first $100,000 invested is the hardest part. It is a massive hurdle. But once you reach that point, the math takes over. The snowball is finally big enough to start gathering mass on its own as it rolls down the hill. The primary reason most employees never see this kind of wealth is a fatal lack of patience. Human nature, especially in the modern digital age, craves immediate, instant gratification. People want to be rich by next Tuesday. They see influencers driving supercars and think they are falling behind. So they take catastrophic risks. They invest their life savings in unproven, speculative assets. They fall for complex financial scams promising guaranteed monthly returns. Or, more commonly, they simply give up entirely, accept their fate as a permanent employee, and go buy a massive new flat-screen TV to distract themselves from their financial anxiety. Warren Buffett's approach is a marathon, not a sprint. It is entirely unflashy. It will not buy you a private jet tomorrow. It will not get you rich quick. But it will absolutely, mathematically guarantee that you achieve true financial freedom and independence in the future. However, we must address the ultimate asset. We've covered the mechanics of index funds, the silent theft of inflation, and the psychological dangers of lifestyle creep. But if you were to sit down with Warren Buffett today and ask him what his single best investment of all time was, his answer might surprise you. He would not say his billions of dollars in Coca-Cola stock. He would not say his massive holdings in American Express or Apple. He constantly and vehemently repeats one core foundational truth. The absolute best investment you can ever make is in yourself. As an employee who is just starting out, trying desperately to build wealth, your greatest asset is not your current savings account. The few $1,000s you have saved is practically irrelevant at this stage. Your ultimate asset is your human capital. It is your earning power. If you want to feed more money into that compounding snowball we just discussed, if you want to reach that $1 million or $2 million mark in 15 years instead of 40 years, you need a bigger shovel. You cannot save your way to massive wealth on a minimum wage salary. There is a limit to how much you can cut your expenses, but there is no limit to how much you can increase your income. How do you get a bigger shovel? You must drastically and relentlessly increase your value to the marketplace. The marketplace does not pay you based on how hard you work. If it did, construction workers and janitors would be billionaires. The marketplace pays you based on the immense value you provide and how difficult you are to replace. To become irreplaceable, you must build what Buffett calls a personal economic moat. A moat in medieval times protected a castle from invaders. A personal economic moat protects your earning power from being replaced by cheaper labor or artificial intelligence. You build this moat by stacking skills. Read dense, difficult books on human psychology, persuasion, and negotiation. Learn high-income, scalable skills that businesses are desperate for, such as complex software development, high-ticket digital sales, data analysis, or direct response copywriting. You must become a lifelong student. In his early 20s, despite having a brilliant mind for numbers, Warren Buffett was absolutely terrified of public speaking. He would physically freeze up in front of an audience. He realized this crippling fear was permanently capping his potential. He could analyze a stock perfectly, but if he couldn't convince investors to give him their money, his knowledge was useless. So, he spent $100 on a Dale Carnegie public speaking course. He forced himself to stand up and speak until the fear vanished. To this day, he does not have his college diploma or his graduate degree hanging on his office wall. The only certificate he displays is that $100 Dale Carnegie certificate. He credits that single small investment in his own communication skills with unlocking his entire career success. If you are currently an employee, sitting in a cubicle, hating your 9-to-5, you must instantly change your perspective. Stop looking at your job as a prison and start looking at it as a paid university. Do not just do the bare minimum, completely mentally check out, and go home to watch Netflix. Use your current job to ruthlessly learn on your employer's dime. Study how the business operates. Understand their marketing, their supply chain, their profit margins. Build a specialized, rare skill set so intensely valuable that you can eventually start your own competing business, transition into high-level, high-paid consulting, or walk into your boss's office and confidently demand a massive salary increase because they simply cannot survive without you. And above all else, as you increase your income, you must absolutely avoid the stupid tax. The stupid tax is what keeps brilliant, high-earning people perpetually broke. The stupid tax is high-interest consumer debt. If you are paying 20, 24, or nearly 30% annual interest on a credit card to fund a lifestyle, to buy clothes you don't need, or to go on vacations you cannot afford, you are actively destroying your financial future. No amount of brilliant stock market investing will ever save you. If the stock market yields 10%, but you are paying 25% in credit card interest, you are moving backward at a rapid pace. You are paying reverse compound interest. It is a mathematical death spiral. Your debt is acting as someone else's compounding wealth. Warren Buffett's golden, unbreakable rule for personal finance is non-negotiable. You must aggressively, violently wipe out your high-interest consumer debt before you do anything else. You cannot build a skyscraper on a foundation of quicksand. The harsh, unavoidable reality is that most employees will never become millionaires. They will never experience true financial freedom. Not because they are not smart enough, not because they do not have the potential, and certainly not because they do not work incredibly hard. They will fail because they are playing a high-stakes game with the completely wrong set of rules. They are trading their finite, precious time for heavily taxed money. They are inflating their lifestyle to impress strangers. They are allowing inflation to eat their savings. And they are relying entirely on a corporate paycheck instead of building independent equity. But you have a choice. You do not have to be most employees. You are now equipped with the exact blueprint that the wealthy use to escape the system. It requires immense discipline. It requires sacrificing your present ego for your future freedom. You must spend drastically less than you earn. You must relentlessly buy productive, compounding assets like broad market index funds. You must avoid high-interest consumer debt like the plague. And you must constantly, aggressively invest in your own mind, your own skills, and your own earning power. It is not a path of instant gratification. It is going to take years of quiet, unrecognized focus. But the alternative, working 40 frantic hours a week for 40 years, constantly stressed about bills, only to scrape by on a meager pension in your final years, is a much, much harder life to live. The choice is entirely yours.